Good morning, students. We are looking into chapter 9, the introduction part of ratio analysis. So, till now, what we have done is about the introduction, the meaning of accounting ratios, and definition of accounting ratios. Then we saw the objectives of ratio analysis, classification of ratio analysis. So, totally, there are two classifications of ratio analysis. One is the traditional classification, which I have already explained. The second part is the functional classification. Here, traditional classification, just to go through it, traditional classification has three categories. One is balance sheet ratio, the second one is income statement ratio, and the third one is interstatement ratios. Here, the first one, balance sheet ratio, it has both the items, whatever we are going to relate, are from the balance sheet itself. So the both items in the ratio are from the balance sheet, then we call it as balance sheet ratio. The second one is income statement ratio. So here the name itself says income statement, which means when both the accounts are from the income statements, then we call it as income statement ratio. The third one is interstatement ratio. So here interstatement is where one account will be in the income statement, the other in the balance sheet. So in that case, we call it as interstatement ratios. Then the second part of the classification is functional classifications. So based on how the performances are, so based on the functions, we're going to classify the analysis, that is ratio analysis. The first one here is liquidity ratio, the second one long term ratio, third you have turnover ratios, and fourth one profitability ratios. So here you have a figure which shows the functional classification of ratios. The first one, what I said, is liquidity ratio. In liquidity ratio we have two categories, current ratio and quick ratio. In the second category, that is long term solvency ratio, we have debt equity ratio, proprietary ratio, and capital gearing ratio. The third topic is turnover ratios. In turnover ratios, we'll have stock turnover ratio or inventory turnover ratio, trade receivables trade ratio, trade payables turnover ratio, and fixed assets turnover ratio. The last or the fourth functional classification is profitability ratio. So here we have five categories. One is gross profit, second operating cost ratio, third operating profit ratio, fourth net profit ratio, the last one return on investments. So these are the ratios for through which we'll be calculating or computing the analysis, ratio analysis. So here let me explain the first topic, liquidity ratios. Liquidity is nothing but where we can easily convert any account into cash. For example, let's take in a business, they produce a certain amount of products, and those are called as stock. Once, whenever we make sale, immediately that can be converted into cash. Likewise, you will have cash in hand or cash at bank, those are already in hand as cash. So those are also called as liquid assets. That is, those are easily convertible into cash or already in cash. Okay, so these liquidity ratios will help us to assess the ability of a business concern to meet its financial obligations, that to short term financial obligations. That's for an example, if any creditor is to be paid, okay, we would have bought goods from the suppliers on credit, and if we have to pay him immediately within a term of 1 year, then we call it as short term obligations, right? So in that case, to meet or to pay off those creditors, we must have certain assets as the current assets. So we'll compare the current or the liquid assets with the current liabilities. This is what we do in the liquidity ratios. So liquidity ratio helps us to assess the ability of the business concern to meet its short term financial obligations, right? Then here, liquidity ratios are further classified into two categories. One is current ratio, the other one is quick ratio. So here, current ratio is where your current assets and current liabilities are compared, or based on the proportion of the current assets and the current liabilities, our ratio is to be computed. So here, current ratio will show us how easily and speedily we can make the payment for the creditors or for the current liabilities. Okay, so here the formula is current ratio is equal to current assets divided by current liabilities. Current ratio is equal to current assets divided by current liabilities. For this, we must know what account will come under current asset, what are the accounts that will come under the current liabilities. Since in balance sheet we'll have all the type of assets like current asset, fixed assets, any other preliminary expenses, all those will appear in the current assets. Likewise, in liabilities also, you will have all type of liabilities like debentures, sundry creditors, bills payable, capital, everything will be there in the liabilities section. So we have to take up only the current liabilities. For that, we must know what accounts should come under the current liability and what are the accounts that come under the current assets. So here you have an explanation for current asset. That is, current assets are those assets that are either in the form of cash or cash equivalents. That is nothing but your cash in hand and cash at bank, or can be converted into cash or cash equivalents in a short time, that is within a year or within the period of an operating cycle, that is accounting period. Okay, so whenever any asset is easily converted into cash, that too especially within a period of time or within a year, then we call it as current assets. So those assets will include current investments, inventories, or we call it as stock, trade receivables. Trade receivables will include bills receivable and also sundry debtors, and sundry debtors less provision for doubtful debts. Then the fourth one is cash and cash equivalents, which is cash in hand, cash at bank. Then the fifth one, short-term loans and advances given. Maybe short-term loans which is being given to other firms or other similar firms. Those are called as short-term loans and advances which we have given. The company has given. Okay. When we give short-term loans, it will come under current assets. When we get it, we call it short-term borrowings, which is we are getting loan from others, then we call it as current liabilities. Then we come to the last one, other current assets like prepaid expenses, accrued incomes, rent received. Okay, so all those will come under current assets. Then moving on to current liabilities. So what will be the current liabilities? This is where the liabilities which are repayable in short term, that is, if we have got certain amount of loan or short term borrowings which are to be repaid within a year, then we call it as current liability. Any borrowings which are to be paid within a period of 1 year, then we call it as current liability. This current liability will include short term borrowings, trade payables. So, here trade payables will include bills payable and sundry creditors. The third one, other current liabilities. Here it talks about the expenses which are payable, that is, outstanding expenses, income which is received in advance, etc. Then the last one is short term provisions. Okay, so these are the part, or these in will in is a part of your current liabilities, right? Whenever your current ratio is higher, then it shows that the liquidity position of the firm is better, which means they are in a position, good, better position to pay off the debt whatever they have got from others, that is, whatever they have to repay to the liability, current liabilities, or to the creditors, right? But again, when it is too high, when the current ratio is too high, which also shows the inefficiency of the management, that they have not invested much. Okay, so their investment policies are not too good. They have not utilized their investments or their properties or the assets in a proper manner. Okay, so current ratio when it is high, one thing is the liquidity position is better because they will be able to pay off the current liabilities. But again, when it is too high also, the investment policies of the management is not good, right? This is your first ratio, that is current ratio. Current ratio is equal to current assets divided by current liabilities. For that, you must know what all will come under current assets and the current liabilities, right? The next one in your liquidity ratio is quick ratio. Okay, so here quick ratio gives the proportion of your quick assets to the current liability. So here quick assets are nothing but except your prepaid expenses and inventories, that is, quick assets is equal to current assets minus inventories minus prepaid expenses. So this will give you the quick assets. So it indicates whether the business concern is in a position to pay off its current liabilities as and when they become due out of its quick assets. So whatever assets, quick assets they have, like cash in hand, cash at bank, then you have trade receivables, that is bills receivable or sundry debtors, any short term loans and advances which we have given. So keeping all these in hand, if we are able to pay off the debts or pay off whatever we have got from the outsiders, then we call it as quick ratio, that is based on the quick assets. If we are able to pay off whatever we have got as we are liable, then we then we call it as quick ratio. So here quick ratio is equal to quick assets divided by current liabilities. So quick assets, as we all know, quick assets is equal to current assets minus inventories minus prepaid expenses, right? And there is another name also for this quick ratio. It is also called as acid test ratio. This other names of each ratios are also equally important because to test our knowledge, sometimes you will be asked like calculate acid test ratio. Instead of asking it as quick ratio, they might ask you to find out like calculate acid test ratio. Okay, in that case you must know what exactly it is, right? So with this I'll complete today's session. That is, you have to write your 3 mark answers, and I have even attached the formulas for current ratio and quick ratio. Copy these in your notebook. If you have any doubts related to these topics, you can easily contact me or just text me in the group itself. I'll immediately respond to you. Thank you, children.